Good morning, folks, and welcome to another great edition of Money Truth Moments with our very own Money Truth expert and whisperer, Judy Copenbarger. How are you?
I love it. The money whisperer. I'm doing
Right.
great. I'm doing great, Carlos. How are you doing?
I'm doing fantastic. I'm looking forward to today's show because we are talking about something that's critical that we don't seem to pay attention to, and that is credit decisions that shape your financial future. So, folks, if you're just joining us, welcome. Make sure you are following Judy at judycopenbarger.today. A lot of great resources on our website. We can talk about that a little later. But what do you say we get started? Because this is a critical subject.
Let's do it. Absolutely. It is a big one. It is big.
So, Judy, many people think of credit as just a number. So, why does the number actually influence so many parts of our financial life?
Oh, yeah. Well, it is your rating, right? You're stamped with this number. It's the fiscal rating that creditors will use when they're trying to figure out how much of a risk you are. If they're going to loan you money for your car or to buy a house or for your business, they want to know how risky you are, to be added to their books. And so that number is a big deal. And what it does is it lets people who might lend you money know how likely they are to get their money back and make money off of you. And so what it impacts for the customer, the consumer, for you, is how much the credit will cost. And the way they move that scale is by charging interest. So if you're a good credit risk and you're likely to pay the money back, they're going to charge you less interest because less people in your category of risk will default on that loan. But if you are higher risk, like maybe you haven't paid your bills on time before, or maybe they don't know, right? You're just starting credit and they don't know if you're a good risk or not, whether you're going to make enough money to pay your bills and choose to do that. They'll charge you a higher interest rate. So it can really impact the bottom line of how much you have to pay for whatever it is you're buying, a lawnmower or a car or a house or, whatever it is. It's not just a number. It has a big impact on your financial world.
So, in talking about that, there's also a lot of assumptions, right? And one of this is why do so many people misunderstand how credit really works? Because there's quite a few of us out there that don't really have a clue.
Well, how would you know unless you looked it up or took a class or had an economics background? You wouldn't know. Maybe life experience. That's where most people get their education. But when you're talking to creditors, you're getting information from the marketing side. I mean, it's about marketing. It's not about educating you on how it really works. Once in a while, you might get a good car guy, in the back office at the dealership that says, here's what you need to do. But most of the time, they're not in that business. They're in the business of whatever they're, trying to get you to do, to buy or to sell or to borrow. So I think there's just a lack of education out there, and most people don't even know what they don't know. They don't know to go learn. It's not a big deal to do, but it's just not always on everybody's radar.
And that's a very good point because it kind of leads me to the next thing where we don't think about this, but what are some common mistakes you've known from people that hurt their credit score when you don't even realize it, right? Because I know we talked about this before in other episodes.
Yeah. And some people come to us for this. They just want to clean up their credit, pay their backpack taxes, and get that rating back up so they can go, fund their SBA loan, fund their business or buy some property or get into their first house. And they've got to do it with a decent credit score. 800s would be great. High sevens is okay. But they come in with very low scores and they don't even know what happened. I think the biggest mistake people make is they close accounts thinking, the less accounts I have open, the better. Not always true, because you might say, I haven't shopped at, that department store in years. And I've had this card for 15 years. I'm going to close that one because I don't use it. And their interest rate's too high anyway. I'll close that one. And this other one, I used to have a gas card for this gas, petrol station down on the corner. Well, we've moved. And I don't really buy gas at that one anymore. Or now I don't even buy gas. I have an EV or a hybrid or something. And so I don't really need that card. And, I've had it. I must have had that one over 20 years. And you close that account. Well, one of the factors of establishing your credit is how long you've had credit. So if you shut down the 15-year one and you shut down the 20-year one and you keep your 5-year ones or less, you have just reduced your credit score without knowing it. That's one common mistake that I see.
Mm. And I think that's a big one because it happens to a lot of us as well too.
Yeah. Yeah.
Folks, if you're just joining us, welcome. Make sure you're following Judy at judycopenbarger.today. We are talking about a very special subject regarding credit and how that shapes our financial future. So I want to take a moment to just have you really just educate us, right? Take a little bit of a deep dive on what factors influence the credit score the most, I would say.
Oh, absolutely. Yeah, this is good to know. There's like percentages of, and allocations of credit score, how you get that big number that you get. So there's the FICO model, and that's the federal model for, how we're going to get that score and then send it out to the vendors that might want to loan you money. 35%, so about a third of all of it, is how well you've paid your bills on time. So do you
Mm,
always pay them before they're due or right when they're due? Are you 30 days late, 60 days late, 90 days late? And if you have 2 or 3 of those accounts where you've been late 30 days or even 60 days and more than once, big impact, big impact. They want you to pay your bills on time. So do that. That's about a third of your score, though. It's not all of it. 30%, so almost a third, is how much you can, how much you have borrowed and how much you could borrow. So what they're looking at is how many amounts. So let's see how if you add up all the money that you are owed, like all the credit cards that you add them all up. The total, let's say, is $50,000. I have a credit card that has a $10,000 max and 2 that have a $20,000 max. 50,000. But the amount that I owe is only maybe 5,000. That would be pretty favorable in your ratio. If I have 50,000 available and I owe 48, not good. That's going to reduce your score because they're like, there's no capacity. You're kind of maxing out. Why? Is it because your ability to pay is not good? That would increase our risk factor for you. Now, what you want to do though is not owe zero. If you have 50,000 available, you don't want to owe zero. You want to owe something because they want to see that you're paying on time. And if you don't owe anything ever, there's no way for them to know if I loan you money and you have to pay it back, will you give us the money that we're expecting? Right. So that's one thing to think about. You want that ratio on this one, this 30% amount owed and the credit utilization. You want this factor to be about 30%. So 30% of the amount of credit you have is the amount that you want to have owing and paying regularly on. 30% of the 30%, right? The other one, 15%, is that length of credit history we talked about. So how long have you been owing money and paying on time? Is it 1 year, 2 year, 5 years, 45 years, right? You want to make sure that you have longevity in those. So don't just go shutting all your accounts down. And then the credit mix, they want to see, is it all consumer credit? I mean, are you just like a perpetual shopper? You've got the Amazon card and the Nordstrom card and the everybody else card, where you're shopping? Or is there, a reasonable mix? Like you have a car or two, you have a mortgage, now you have a little consumer. They're looking for that mix. So 10% is just that mix. And then the other 10% is how often or how recently have you had your credit checked? Because when your credit is checked, that means somebody wants to loan you money. So if you are going to go buy a car and they see that you have pulled your credit or potential creditors have pulled your credit 8 times in the last 2 months, they're going to go, wait a minute, they are in the borrowing mode. They're borrowing, borrowing, borrowing. Why are they borrowing? Could it be that they're having trouble making ends meet and they need
mm,
cash flow? If they need cash flow, do I really want to loan them money and try to get paid back on time? So that 10% is impacted by your new credit that you have opened. And then you've got that credit mix you want to look at. So those are the real factors. Most people are surprised by a couple of those. Like, I didn't even know they cared about that, but they do.
right.
So make sure, I mean, it's easy to have your credit score go south, but it's also very easy and very quick to have it come back up like dramatically. We do it all the time.
I've heard you talk to this about the youngsters going to college, and maybe we can take a moment to do a little public service announcement. So there's always something that you warn the youngsters as they're leaving high school, they're getting into college. You want to talk a little bit about that?
Oh, yeah. Well, back in the day, before we had all this, stuff coming at you online and on your phones, we actually had to talk to people. So when I was in college, we talked to people. And so all of the vendors would come out to the schools and they'd set up long tables out along, on the quad, along the sidewalks. And they'd come a lot of fairs, like live fairs where you meet people and they sell you your stuff and you see what's going on, right? What clubs to join, things like that. But they would always have all the vendors out there, and there were always all of the big credit card companies. And they would line up and they'd give you a free t-shirt or a free candy bar or free something if you just sign up for this free credit. Well, now here you are as a student, maybe first time out of home, a year or two out of home, and you're like, wow, they're going to give me all this money. I can go get pizza and I can go shopping and I can buy whatever I want. Oh, you mean I have to pay? I have to pay it back, mom,
Right.
dad. Um, and so people get into trouble early. So I like to warn students and young people that just are being exposed for the first time to credit, how fun it is to have a card that you just go get what you want and bring it home without having to give them cash or swipe your card, right? But you do have to pay it back. And you can plan on it being, if you pay it over this schedule of time with the minimum due that the credit card will give you on the statement, you're going to pay back about 50% of what you paid for it, sometimes as much as twice. So you have to say, well, that cute little outfit I bought for $30 is actually going to cost me 45, 50, maybe $60. Is it worth 60? Or should I have just saved my money or use cash for the $30? So that's one way to think about it. But that's a trap that young people often get into because it's free money, right? Not so free. So just be aware, if you hear people coming at you, and right now a lot of it is online. So you get the
Mhm.
ads and this rate's low and this one's great. And there's this, super introductory rate and no interest for a whole year. Wow. Free money for a whole year. Well, then what? Now the interest is due and you have to make the payments. So just be aware of that. You want to have some credit. You don't want to have zero credit. Like anybody that says don't get a credit card, bad, 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 right? You've got to have it in this world to be able to move, to rent a car or to get a hotel or to buy anything online, have it delivered to you. You've got to have a credit card. So get one, be responsible with it, know how it works with your credit and your interest rates, shop the interest rates, and you'll be just fine.
Yeah, it's funny because a lot of folks don't realize that that introductory rate you get, well, all of a sudden it can jump to 30%, 34, and so forth, and they don't realize that as well too. So something to
34%.
definitely,
It's crazy. We say it like it's only 34%. That's crazy. That's one
yeah,
third more per year that you're paying. And they'll have you pay it off over 10 years. So what is that? How many X's times
mm,
the cost that you actually bought the thing for that you're paying back? It's terrible.
yeah.
Terrible.
So we're talking about this. It's a great PSA for the kids and stuff, but someone who's in that situation now, how can they improve their credit if they feel stuck or they feel overwhelmed?
Well, step by step, it can be very overwhelming to have money that goes out every month that really doesn't impact your life positively. You're just, paying debt. And when that number gets real high, when that percentage gets real high, it feels really bad. I've been there. I mean, most of us probably have at some point. It's terrible. So I think little by little, eating the elephant a bite at a time, right? Just start with a list. You got to look at it. You got to say, this isn't working. I'm ready to do something about it. Just Nike, right? Just do it. So you make a list and just look at it. And if you've been hiding from your spouse, if you've been hiding from your family, the actual debt you have, it's time to come clean and say, we're going to work on this. Here's a goal. Our goal is to dig out, right? If it's serious and you just really cannot make even the minimum payments of all of them, you might want to get some help. doing that and negotiate it. I always say, pick up the phone, call the credit card companies and say, look, I have $2,000 a month I need to service a debt. I can afford 1,000. So give me a lower rate and give me a lower amount minimum, and I will pay you back. If not, nobody's going to get paid back. I'm going under, right? And usually they will offer you something. There's always a way to get that done. And if it's beyond you to do that, or that's just, too scary or too hard or too overwhelming, get somebody to help you with the credit. What I don't like is these companies that just consolidate. They make all these little hard to pay bills balled up into one big impossible to pay bill. And you're still in it, but now you're in it with another creditor. So those can work, but just be aware. It's going to have to be a commitment. But step one of all of these steps, the first bite of all of these bites is just write them all down, take a really good look at it, and then come up with a plan, either with or without a professional, to get it done. And then you can map it out. Is it going to happen in 6 months, 2 years, 5 years? What is it? And time is your friend, right? Time's always coming at us. So use the time, make a list, and get started. And you got to face the music, right? If you're there.
So I want to try to squeeze in one more question before time runs out. And if you can briefly tell us, why should people think about credit as a long-term financial tool instead of that short-term borrowing?
Well, because the impact of the credit will impact your bottom line forever. Like if you owe money, if you have a mortgage, if you have a car payment, if you have any kind of debt, student loans, any of those, you are paying money every month from the income that you have. So it's an allocation of your expenses from your income. So if that's happening every month, that's going to impact money that could go toward a future goal or for your future retirement or your long-term plans. So every month, even those little bits is going to have a huge impact on the long term, the trajectory of growing your family wealth and your legacy wealth ultimately. So this makes a big difference. It is a big line item for a lot of people.
Folks, and with that said, we're at the tail end of our show. You know what that means. Shall we call this the credit challenge, or what do you want to call it today?
The credit challenge, absolutely. So here's the challenge for you. If you haven't looked at your credit in the last year, go ahead and do that. Pull your credit report. There are 3 big agencies that do that. Experian, there's 3 of them. And then identify just one thing that you can do to increase your credit score. So now that you know what the factors are, how long you've had credit, how many, what your ratio is, debt to potential ratio, the credit mix, all of that. Review your report and look at one thing that you might do to increase that score. If you're not already way up in the 800s, right? You can do that, and you can do that this month. We got tax time coming up. So before you file your taxes, or if you've already done that, congratulations, that feels good. Before April 15th, here's a goal, pull that credit report, write down what you have there, if that's an issue for you. And then one thing that you can do to make that number go up rather than down. You can do it.
All right, folks, there is your challenge. Don't forget to follow Judy at judycopenbarger.today. We are here every Tuesday morning at 8 a.m. with the replays on Thursdays at 8 p.m. With that said, it was an impactful show. Any last parting words, Judy?
Nope. Make it a great day and a great week.
All right, folks, until next week, stay safe.